Peter Rose, Longwood Currency Trading. What are the differences in trading, day trading, for a small or a short profit target as opposed to a longer profit target? In most of the videos that I've done, all the videos I've done, I do a 5-period ATR on a 5-minute chart. It has a 5-period ATR. And I won't even look at a trade unless it's offering me 20 pips. And I don't really expect to get the 20, but I'm looking for a probabilistic availability of 20 pips in a particular move, a particular momentum series of candle moves in order to get that 20 pips. What I'm really trying to capture is 10 to 15 of those pips when I win. And that's the reason I set a short stop of 8 pips, because I want to be able to really make almost twice what my risk is on my trade. And over a series of those trades with a good win-to-loss ratio, which I have, when I'm on my game, I can do 70% win-to-loss. So, you know, in 7 times I win 10 or 15, let's say, and the other 3 times I'll lose 8. So I'll lose, you know, 24 pips, and then I'll make 70. If I get 10 pips on a trade, I get 70. So 25 less than 70, or 40 for 48, something like that pips over a 10-period series of trades, leaves me with a per trade expectation of a 4.5 or so, 4.8 pips per trade. So if I'm making 5 pips per trade every time I step up to the plate, then I'm making, you know, over the 10 trades, I'll make 50 pips. So that's what that factoring comes into. And I consider that 20 pip profit target to be a close profit target. I don't think that that's very many pips, particularly when you don't achieve them all, and you get that 10 or 15. You get 15, you're doing really good. You get 10 of that, you know, half of the number of pips available is right in that sweet spot where you say, well, you got to kind of wait for the price to go about 1/3 of the way before you confirm your trade, and you want to get out about 1/3 of the way from the profit target because of structural zones and, you know, all that other kind of crap. No profit target is a target. It's set there because of structural resistance, let's say, if you're going long. And so there's a band there. That profit target could be 8 pips on either side of that line, depending on what sort of resistance zone that's going to be. And so you can't expect to get all the way up there. So about 1/3 of the less of the way from there, you're capturing the middle third of that 20 pip move. 6, 8 pips, you know, 7 pips is about mid-range. So if I'm judging the momentum of my trade pretty good, then I'm in that 10 pip zone before price starts to retrace, and I mean, that's why I'm getting out, because I have such a short distance that I'm working with, that I can't afford to have it go to profit and then swing around in some sort of a reversal, because a reversal on a 5-minute chart with a 5-period ATR could be 6, 8, 10 pips, right? So as soon as I see that start to turn around, I'll grab whatever I have. So that trade entry analysis that I do is so critical when my profit target is 20 pips. And so that's that short story. All right. Well, what if you sit down at your trading desk, as I have Well, I just did a trade the other day before the weekend on Friday, where the profit target was way open. It's like 50 pips, and so I'm saying, I mean, and there's a lot of real estate between where I'm taking the trade and the 50 pips. It's clear. There's no real structural encumbrances. All you're going to do is run into a normal retracement of 10 or 15 pips, which if you're going for a 15 or 50 pip profit target, you have to be willing to take that 10 or 15 pip reversal and just let the thing ride. And so when you're trading for the short profit target of 15 pips, you're pretty much relegated to all in, all out. Or if you want to go in with a couple of lots and pull one off at the 5 or 8 pips and bring the stop to break on the other one, then it's a free trade from there. And then if it moves, you know, let's say you pull off at 8 and the trade moves to 10, you might want to add another one, and now your average is going to be between where you were and the 8 or the 10 periods. So now you're at 5, so you're averaged about 5 pips then, and price is at 10, let's say. So now if you get a retracement, you got to be real careful, because if it drops 5 pips, you know, you're out. So your real estate for staging in lots with a short 20 pip profit target before you hit that reversal, I mean, it's jump ball. When you get up to around 10 pips of profit on that 20 pip profit target, you're really in a 50-50, is it going to go, is it not going to go anymore? And it's all based on the momentum of the candles at that point. You have to really pay attention to that. Whereas if you're in a longer profit target real estate situation, then the capability for staging in becomes much higher. You have to be careful with the stage in, because if you stage a little too heavy, the further out that you go, it brings your average value of the trade way up, close to where current price is. And so any sort of retracement is going to grab you. So if you're planning on staging, you've got to stage in most of your stuff low, so that as you stage further lots in as you go forward, you're not moving the needle on your average value very much, so that you can take, you can sit there and you can wait. You can say, maybe this is going to be a 10 or a 15 pip reversal, and maybe your average is 6 or 8 pips below that. And so that you can say, well, okay, it's come down to 15, I don't really have any faith in it, boom, now I'm out, my average is 8, so I'm picking up 8 pips on, let's say 5 lots or 6 lots. I mean, that's a pretty good day, right? And you can always get back in. But when you get back in, you can't get back in heavy, because now your take point is closer to that profit target, so that you've got to go in light and just look for the smaller moves. You don't want to lose the profit that you gained on that previous trade. Whereas when you're trading for the shorter term profit target, when you clear that trade, you're done. You're not going to re-enter the trade on a continuation of price. You've got out, and that was based, that profit target was based on entry conditions at current price when you entered the trade. So now, if you're going to, excuse me, if you're going to enter the trade again, it's not like staging in to the current situation. You have to do a completely new entry analysis on that structural environment that you have at that particular time, in order to determine whether you have a valid take point, whether you have a valid entry point. And then you have to decide, well, I mean, you're very close to where, you know, if that price is continuing on, you've still got that original profit target that you set. Now, that original profit target may be 8 pips away. So you're not going to be taking a new trade somewhere 8 pips or 5 pips below what that entry point was. I mean, excuse me, where that profit target was, because you're too close to it. You identify that profit target as a profit target because, let's say you're going long, that there's some structural resistance that you've set up and determined that that's about as far as price was going to go, is at 20 pips. So you're going to have to wait then and reevaluate when price goes through that profit target. And generally what happens is when it goes through a profit target, just like a breakout scenario, something like that, you're going to have a retracement back to the break point or that profit target line, that resistance line, which now becomes support. You'll have a loop back there, and then it'll either come crashing back through that to flush everybody out, or it'll do a bounce and continue on from there. Well, that's not magic, juju, Fibonacci spiral of death shit. That is order flow. That's how an institutional trader is collecting inventory and then distributing that inventory out to get the best price that he can for his client. And so when you have those bounces, that's an indication. Well, I mean, you know, in other words, it goes through the resistance point, it comes down back to that resistance point after everybody gets in, it comes down to flush all of them out because their stops are there, and then if it continues on back up, you go, whoa, are you going to back the truck up and load into it, because you know that the institutional trader just picked up whatever that retracement was, he's going to double that on the way back up move, because he's trying to get the best price for his client. Now, the question is, did that last drop, did he complete his order? And is he going to continue that on? Or is he done for today and he's going to pick it up tomorrow? You don't know those things. So you have to really, really be very careful about evaluating positions after you've already been in a position. You can't just stack this shit on top of each other like a bunch of boxes. I mean, there's a whole strategy, I guess, in the old days about these zones, trading between the zones. So when you'd have a breakout from one zone, you'd be going into another zone, and so you'd play that until you got to the next zone. There's a guy, how he made $1 million in the market or whatever. I forget who wrote that, but that's he was a dancer actually and traded, and that's how he made his money doing that. Richard Ney in 1975 wrote an interesting book called Making It in the Market, and his approach was the specialists, who we now would consider the institutional traders executing orders for their clients. The specialists, that's what they would do. So if you wanted to sell some stock, they would buy it from you, and then they would turn around and sell it, and they'd make the difference on the spread. That's what we're bid and ask on our stuff that we're doing today. It was done by a person. And what Ney found out was that someone who was the specialist for General Motors and maybe several other stocks might not necessarily be other car stocks, but whatever he was a specialist for, the campaigns of money distribution into the market and order flow were similar. So that what he did is he found out who the specialist was, that he had access to the data, and which stocks that particular specialist covered, and then he'd trade all of that specialist's stocks the same way, because there was a high correlation between, excuse me, the activity of that price. Now we see that very clearly in correlated stocks. You have pound dollar, you have a dollar yen, you have Swiss dollar. When you are learning trading, they tell you, well, don't trade correlated pairs, because the price action is going to be relatively the same. Well, why is it the same? Is because the dog in all that, the dog in all the majors, is the USD right now, right? Because that's the reserve currency of the world. Might not be for long, but right now that's the way it is. So that anybody that's trading dollars is trading them the same way against all these other corresponding countries. So that you'll find that if you watch the pound dollar and the euro dollar, the movements are going to be a little bit similar, very similar. Euro dollar isn't quite as volatile in its action as something like the pound dollar, but then if you go to Aussie dollar, you're going to have a lot of volatility because the market starts to thin out, but the patterns are going to be very close, because everybody's trading the dollar against. Well, you could do the same thing with the yen. Take the yen pairs, or take the Aussie pairs, or take whatever, and you'll see the correlation. And so I guess the reason I'm discussing this is because whatever pair that you're trading is going to have some correlated action in other denominated pairs that you have access to trading. So one pair might be trading during one particular period of the day, like if you're trading euro dollar, you're trading that during one period of the day. But if you're going to trade the yen, dollar yen, you trade that during the Asian session. The point to be made is when you're trading in short-term profit targets, that your thought process as to how continuation trades are going to be made, as opposed to what happens when your profit targets are further out, is highly dependent on the time that you're trading. Because as that time period shifts from a very active period into a more dormant period, when that particular prime country in the pair switches from a European session to an Asian session, the action of, or the attention of the dollar trader, let's say, shifts now to the Asian session, and so your ability to reach even the short profit targets is reduced, let alone going for the long pull. Whereas you might be able to make a 30 or a 50 pip profit target if you traded 4 or 5 hours during the day. You might be able to do it in 10 minutes. You might be able to do it in 1 minute. But you look at the chart that you're trading on, and you can see the time differential that's involved there. So you have to be cognizant of not only the pair that you're trading, but what time frame you're trading on, as to the likelihood that the price is going to get to that particular area that you're at. And so many times what happens is I'll be in a short or a small profit target scenario, and the thing will be moving in that direction, but it's consolidating, and all the fundamentals are good for it, and I'm tired of trading for the day, so now I've got to do a reanalysis. I'm not going to close the trade if there's good value to be had, because I've already loaded up on the number of lots that I'm trading there. So now I'm going to shift my attention. Where is the next structural profit target point? And is that a stronger area or a weaker area than where I'm at, to set that next profit target where I'm going to do a carry trade to? And hopefully that'll hit. Well, it's got to go through the night. It may get there during the opening, 2 o'clock in the morning, 3 o'clock in the morning, my time on the East Coast, United States, if I'm trading the euro dollar or something like that. There'll be a lot of volatility at the open, like London Open or something like that. And there very, very well be a huge pullback at that time. So you have to really do your entry analysis totally differently if you're going to go into a carry trade, or you're going to continue the carry trade onto that next profit target. It becomes really problematic. Before you close down for the day, and you're going to do this carry trade, are you going to set some more limit orders, buy limit orders? Thinking that, well, you may get this retraction, so maybe I want to do some continued buys instead of selling out of the position. Maybe if it comes back, I'd want to pick up more lots and do that. So you really have to understand statistics and probability and how to apply the probabilistic view of the currency market in order to determine, am I going to carry, am I going to put retracement stage-in orders, am I going to put stage-in orders above where the current price is, what's my long profit target going to be. This is for if you're going to do carry trade. You wouldn't do this per se if you're doing a long day trade situation. All those factors anyway have to come into play. So it sounds more complex than it really is. What I would suggest that you do if you're a day trader, I mean, the same idea is true when you're doing the longer term trades, and certainly more viable when you're doing the longer term trades, because you've already got a tremendous distance the price has moved, if it's going in your favor, to where your original lots were put in, that staging becomes a relatively easy thing. I mean, the next time you stage, you can really dump a ton of shit in there. Sure, it'll bring the profit target up to halfway to where it was. In other words, you double what you went in, and that'll split the difference in your average price. But you're still so far away from that that even if you had a 40 pip retracement, it's not going to hit your average stop. Or if you're doing a really long trade and you got a lot of confidence in it, you just dump all the lots in at the open and just let it go. As long as it doesn't stop you out at the open, you just let it go and run your stop behind it. The problem is in running a stop is that if you're not accounting in that stop for reasonable retracement, you're going to get taken out at a good price, but certainly very early, because the thing may come back down, way down, and then turn around and go back up. If you set your stop way, 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 way down and the thing retraces and takes you out, now you've committed all those lots to this way out profit target with a stop that takes you out. I guess what I'm saying is you're not getting paid for the time that you hold the thing. It doesn't matter. Maybe you make 20 or 30 pips on the deal, and you get 30 pips on a 10 lot. Did that really pay you for the 10 days or the 20 days that you were in the trade? Does 30 pips, I mean, it's good money, but for the amount of risk that you had, is it enough? So, to simplify it, determine whether you're going to be a day trader or you're going to be a longer term trader. If you're going to be a longer term trader, then you can take the stuff that I'm talking about in the short-term stuff and you can map that up. But if you're doing long-term trading and you're building all your strategies on that, you can't all of a sudden then decide you're going to take that stuff and you're going to map it back down and trade for a 20-pip profit target, because you'll screw yourself up. You won't understand the sophistication of the trade. That's why I'm an advocate for the shorter term trade, because you have many more decisions that come up, and you have many more losses that you take to learn from. Whereas if you're doing long-term trades, you may, 10 trades might be 4 months. It might be longer. So you have to really consider the difference in the real estate that your trade is dealing with as to where you're setting these profit targets and how much retracement that you could potentially experience on the time frame of the chart that you're using. That's the key in analyzing the difference between looking at a close profit target or a little bit longer medium range profit target. Let's say you're going from a 20 pip potential profit target to a 40 pip potential profit target. That's a big profit target for a day trade. I mean, I'm just telling you that you're not going to get 40 pips on a day trade unless maybe you get really lucky and you get a spike or something else happens. So you got to be really careful about setting those longer term profit targets. An extended profit target for me would be 30 pips. I would never set the, I mean, if there was a profit target that was 50 pips up, that wouldn't be what I'm thinking about. I'd just say, okay, I'm looking at 20. Can I make 20? Because if I can make 20, if it's got the juice to go to 50, it's certainly got the juice to go to 20, and I'll take 20 pips any day of the week. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.